My name is David Jaffee. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com. Retire early running the wheel strategy options on SoFi. $12,000 a month tutorial by Options with Ryan. Let's check out what he has to say.
In this video, I'm going to show you exactly how to generate $12,000 per month in safe and semi-passive income utilizing the wheel option strategy on SoFi Technologies. Now,
the problem with the wheel strategy is that the premium that you make from selling call options is a drop in the bucket compared to what you lose during a bear market. And by selling call options, it caps your upside.
SoFi is a solid company. In fact, if you take a look at my portfolio, it's currently at 700.
That's actually really weird. He says he has a $735,000 portfolio, and he says that he's been up $53,000 over the past 3 months. Yet, if you look at March 9th, it looks like he basically liquidated his account, and then you can see that he added money to it. My gut feeling here, and I have no way of knowing this, but I believe that he's adding money into his brokerage account from his subscribers and from his members. That's why it shows a 7.77% increase in his total account value. I believe that increase in account value is due to him depositing money, and I don't believe that it's due to his profits from actual trades. As you can see, March 11th, his account basically goes down to zero. Then something similar happened on April 3rd. His account, basically from April 3rd, it looks to me like it dropped below $50,000 or $100,000, and then it skyrocketed up. The only logical explanation that I could possibly think of here is that he's depositing money into his account in order to make it seem like his account is growing based upon his trades. And then also, if you look at his gain-loss, every single position that he has is showing a loss. You can see in the top position, it's minus 8%, minus 11%, minus 29%, minus 9%, minus 31%, minus 18%. So it simply doesn't add up how he's showing an 8% gain over 3 months, and he has so much variability in his account value.
35K. This is just my live portfolio here on YouTube that I plan on turning into 10 million. If you want to watch that,
he's going to turn it into $10 million if his viewers end up paying him an obscene amount of money to learn something that they can probably end up learning for free.
Make sure to be subscribed to the channel. But SoFi makes up about almost 10% of this portfolio, and that's how much I believe in this company.
Okay, so if SoFi makes up around 10%, then my gut feeling is that he's down around 18% in the position, because percentage of holdings, you can see right here, it's hard to see because it's so small, but that's around 10. And it shows that the gain loss is down around 18%. It could also be this one that's 11% of the holdings, and it's down around 1.45%, but who knows? In any case, it's down.
So I'm going to dive into exactly why I run the wheel strategy on SoFi. We're going to dive into the fundamentals of the company, just in case you don't know too much about the company. And then we're going to dive into the exact strategy on how exactly we're going to make $12,000 per month pretty passively here on SoFi Technology. So let's go ahead and dive into it. First, fundamentals. Okay, so feel free, if you already know about SoFi Technologies, you know about their fundamentals, you can go ahead and skip ahead to the actual strategy.
Yeah, I'm going to skip through because I want to talk about the strategy, not the actual company.
3 criteria when doing the wheel strategy, and I'll dive into exactly how the wheel strategy works. But SoFi meets all those requirements. So if you look at the chart, right, we could go back to 2023, and you could see that this chart is upward trending, okay? It's an upward trending chart. That's obviously good. You don't want to trade stocks and options on stocks that are downward trending, especially in a bull market. Now, obviously, we had a large crash because the stock market crashed, but it's still upward trending since 2023, and that's what we want to see versus...
There's so much subjectivity when people use technical analysis, and I think that's one of the primary reasons why almost every single retail day trader ends up losing money. So while I definitely believe that looking at the price action of a stock is important, all these lines on charts, in my opinion, are basically a pseudoscience with zero predictive value.
Like, I like to pull up AMD as a good example of a stock that's very, very hard to trade the wheel strategy on because it is trending downwards for the past year and a half.
Yeah, I definitely agree with him on this, in that trading the wheel strategy on a stock that's decreasing in price is basically like trading dollars for pennies, because you're collecting pennies when you sell call options, but then you're losing dollars as the stock price decreases.
Example of a stock that's very hard to trade the wheel strategy on. So SoFi, great chart, great fundamentals, and the premiums are especially high in the options. So we'll kind of dive into that. So you're selling an option to someone who maybe they just want a piece of insurance on their stock just in case it goes down. They want to be able to sell it at a price. You know, for instance, maybe they own the stock at 80, and if it goes down to 50, they just want to be able to sell it without losing any more money. And we are forced to buy those shares. Now, if it doesn't go down there, then we just collect the premium that they paid us for that option, and we do it all over again. So as you can see, we're going to sell puts, collect the premium, and you'll do that for several months. Sometimes it takes up to 6 months to get assigned on a stock, especially when the stock market just keeps going up and up.
I actually would prefer to sell more aggressive put options on stocks that I want to take ownership at a strike price where I would love to get assigned, especially in a market like this where valuations have come down significantly and some of the prior market leading stocks are down 30 or 40%. It makes sense to take ownership of that stock and then ride it all the way up.
So you collect your premium, sell puts, then eventually maybe the stock market dips and your stock dips down below that put price. Now you get assigned 100 shares. You still collect the premium, but you have to buy 100 shares.
Psychologically, if you sell put options that are too far out of the money and then the market corrects by 20 or 30%, people start thinking that the stocks that they sold puts on are damaged goods. And then they don't want to get assigned because they're concerned that the market is going to continue to crash. As Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. It definitely makes sense to take ownership of stocks when the stock market has incurred a 20 or 30% correction.
And now since you have those shares, you could then sell covered calls against your shares to collect additional income. Once the stock goes back up and goes past your calls, your shares get called away at a profit. So you get appreciation with the shares, and you also get paid a premium. So that's double income. And then you do it all over again. Okay, that's why it's called the wheel strategy. So how are we going to do it? Well, the first thing we have to do is sell cash secured puts, okay? So I'm going to show you how to make $12,000 per month in safe income selling 25 to 35 delta cash secured.
This actually is not a bad strategy. However, in order for you to make $12,000 in premium on the puts, especially when he previously used the words cash secured, meaning that you're not going to use margin. So at an absolute minimum, if you have a $100,000 account and he's saying that you're going to make a minimum of $12,000 a month by utilizing this strategy, that means that on a cash account, he's targeting 12% a month. That's completely ridiculous. Then he's telling you that you're going to sell the 25 to 35 deltas on the cash secured puts. That means that those options are going to become in the money around 30% of the time. So it's a relatively far out of the money trade. Let's check that out real quick. So you're going to go 30 days out, and then you're going to sell a delta that's about 30. But let's be clear here. SoFi has earnings on April 29th, which means that these premiums are elevated and you're going to collect even more premium than you're usually going to receive. But let's give him the benefit of the doubt. Let's sell a 30 delta, which means that we're going to collect around $73 for every contract. So therefore, if we're going to collect $12,000, we're going to need around 170 contracts, is 17,000 shares times $10 is $170,000 of buying power. That means that in order to make this trade, you're going to need an account size with $170,000. Also, because VIX is high and earnings are coming up, I believe that the amount of premium that's currently being quoted is way bigger than it usually is. So during periods when VIX is trading at 15 to 17 and there's no earnings coming up, this trade, instead of giving you 73 cents, is probably going to give you something closer to around 32 cents. In which case, instead of 170 contracts, you're going to need around 380, and 380 means that in order to generate $12,000 a month, you're going to need an account size with $380,000, and you're going to have to put all of it into SoFi. So it's not realistic.
25 to 35 delta cash secured puts depending on your bullishness. Now, what that means is basically if you sell a 25 delta, you have a 25% chance of being assigned on the stock. So very low chance. 35 is a little bit more aggressive, but you get paid for that aggressiveness. You get paid more, and you have a 35% chance of getting assigned the stock. All right. So let's go ahead and go over to the account. As you can see,
yeah, I don't think that there's any doubt that he's adding money from his subscribers or from his bank account or externally into his account to make it seem like he's making money. If you look at the individual positions, he's down money on Google, down money on Hood, Nvidia, he's down 24,000, etc. To his credit, he is invested in solid companies, so I do think that he will make money as the market increases in price. But let's continue onwards.
We have lots of positions here, and one of them is on SoFi, right? We have about $21,000 worth of shares, and we have about $26,000 worth of cash secured puts. Okay, so we're going to go to SoFi. As you can see, I have 12 and a half puts, 12 puts, 13 puts that are all in the money because the stock's trading at 11. So in 7 days, I probably will get assigned at $12, which is totally fine.
That's a lot of contracts, though. He's trading too large. He's talking about trading cash secured puts, and he has 3,300 shares. That's around $33,000 worth of stock that is set to be assigned to him.
So yeah, let's go ahead and dive into the options chain. So we're going to go out about 30 days. That's the optimal time frame to sell cash secured puts. You collect a lot of premium, but you're not going too far out in time to where you're taking on too much risk. Okay. So 28 days, we'll just go to 28 days. All right. We'll click on that expiration and we will go ahead and sell the 30 delta put. As you can see right here, that's the $10 strike. And to show you where that is on the chart, basically $10 is going to be right here. So the stock would have to go down below this shares. Let's go ahead and calculate the return there. All right, so we're going to collect 67 cents or $67 if we multiply that by 100, right? Because there's 100 shares. Okay, so it's going to be about $1,000 per contract in collateral. And that's about a 6.7% return in 28 days. Now, let me show you how that looks on an annualized basis. That's about an 80% return on your money.
The thing is that there's no free money. Risk is elevated. Volatility is elevated, and you have upcoming earnings. There's no free money in the market. The reason why it's paying you such a high return is because the market believes that there's substantial risk in that trade.
You're generating $80,000, right? So it's quite substantial, especially if you have like $200,000, right? You're going to be generating a good 160K. So it's a pretty substantial amount of money to be doing this strategy. So let's go ahead and see how much we would collect if we even went a little more aggressive and sold a 44 delta because we think that, you know, SoFi is going up from here. We'd collect $1.09. We're generating a substantial amount from these put options. So that's how you do the cash secured puts. Now, what happens if the stock goes below your strike price and you get assigned, right? Let's just pretend that SoFi is trading at 11.06. Let's just say we had the 11 puts today. We got assigned at 11, okay? For instance sake. Now we have to sell covered calls to collect income. So as you can see, what we're gonna do is, let's just say the stock, and you wanna enter on a green day preferably, and let's just say we got assigned at 11. We're going to go to the 30 delta. There is no 30 delta. There's a 28 delta, okay, which is the 13 strike. We're going to collect 40 cents. Now, how are we going to supercharge our returns? How do we make even more than that? Well, there is a strategy, and it's called buying leaps call options. How I supercharge my returns is I buy a 70 delta leaps call option 1 year out or longer. The stock has to be at the lower Bollinger Band. VIX has to be above 15, which is
I don't understand why the VIX has to be above 15. The higher volatility is, the more expensive options are going to be. I guess you can make the case by buying leaps when volatility is high that the market has already pulled back. Therefore, there's a higher probability that the stock market is going to fill in the gap and recover its previous losses and increase in price. But I'm not certain why he would purchase leaps when the VIX is above 15. It's a little bit convoluted to me. I can tell you that when you want to hedge your portfolio, I prefer to buy a few put options when I believe the market is overbought and volatility is below 15. And the reason for that is VIX is a measure of complacency. So when everyone is complacent and they believe that the market is going to continue going up, then it's a good time to buy some protective put options. But in this situation, I don't understand why he requires that the VIX is over 15 in order to buy some call options.
Fear and volatility index. So let's take a look at SoFi and see if this would work out. Well, we are below this middle ball.
I'm not really a big fan of this strategy, especially on something like SoFi, but I could be wrong. I don't think it's the worst thing.
Band line, but this is most likely going to be worth like $5, right?
Overall, I don't think that this is the worst strategy. It's going to require anywhere from $100,000 to $300,000 in order to execute. Plus, keep in mind that even if you have $100,000 to $300,000, you're then going to have to concentrate everything into this SoFi position, which is a relatively high risk stock. This is a very simple strategy that you can learn for free elsewhere, but it's not the worst strategy. And I don't think that Ryan's video is terrible. So if you have any comments, then leave a comment below and I'll do my best to answer your questions and respond to your comments. Visit beststockstrategy.com and submit your email address to receive valuable free training. Please give this podcast a positive rating and review. If you have any questions, visit beststockstrategy.com and send me a message.